that impacted the trade of oil as well as the refinery of oil. So refinery is right now the main cost of our fuel, and it has surpassed the cost of oil. And so the refinery costs have gone even higher with the shutdown of a couple of refineries down in Florida, as well as on the Gulf Coast. And that is causing the main impact of the increase in fuel prices. In terms of imports, what's going on with imports? Imports were down significantly in September. It was actually the largest decrease month over month that we've seen since 2020 and COVID. And there's a couple main factors for that. The largest factor is most likely inflation. Inflation has hit the U.S. economy as well as the world economy significantly. It's actually impacting the world economy more than it is the U.S. economy. The U.S. dollar is actually too strong right now, and it's causing significant problems in the rest of the world, making things very, very impractical for a lot of countries to use the U.S. dollar right now. The other thing is inventory levels are at a much higher rate than they have over the last few years. We're actually predicting that this year retailers will, for the first time in the last few years, actually see some real deals in Black Friday because of that oversupply in the retail market. So what that means is the warehouses are too full, and therefore they don't need to continue to buy new product. So we're not seeing the typical holiday push that we saw on the ocean side that we have the last few years. Where do we expect the ocean freight to be going? Historically, the last quarter of the year is slower on the ocean side, and it is going down, and we expect it to continue to go down through the quarter, through the end of the year. We don't expect that to change. There's nothing showing that it will change. So do expect to see slower imports over the next few months. That being said, imports are still not at a bad level. There's still over 100 ships outside of waiting to get into U.S. ports to be unloaded. And so there is still a significant amount of freight coming in. It is just less than it has been over the last few months and the last few years. So good or bad, we are seeing imports slow down a little bit, and it's allowing the ports to kind of catch up and have less ships waiting. We touched the base a little bit on this last month. The East Coast ports and the Gulf ports are still significantly heavier historically than they've ever been. They are less busy again than last month, but the majority of ships waiting are actually in the East Coast and the Gulf ports. The West Coast ports are only seeing an average of 3 to 4 ships waiting outside a port. So the West Coast is still very, very slow compared to what it's been historically, and the East and Gulf ports are historically still heavier than they have been. What's going on with the rail lines? So some of you may have heard the third largest union on the rail lines actually rejected the deal that was made. They voted against it, and they have agreed to delay a strike until middle of November after the Congress break. So at least then it will give Congress a chance to force a decision if needed. But that being said, they did reject the deal, and there is now, again, a possibility of a strike. Of the major unions, only 3 have actually signed deals where the unions have actually agreed to honor and agree to the current deal. The other unions are still up for debate and not expected to come to a decision until November. The 2 largest unions are in those that have not yet come to completed vote. And so we are going to have to keep a close eye on those. The main issue right now with the union that rejected it is off of personal time off, and vacation. They feel that they're not being honored, and it is causing an issue that they obviously felt it was strong enough to reject the current deal. Going into dry van. So what's going on with the dry van sector? Dry van has continued to see a decrease in rates. It's been almost 4 months straight now that we've seen rates decreasing. Uh, there historically is a push in September and beginning of October for retail, where we will see a spike in rates. We are not seeing that right now. Even with Hurricane Ian pulling capacity away from some of the southeast, we are still seeing rates go down on a national level. The only exception right now where some rates are increasing is in the PNW. So Idaho, Oregon, Washington, produce season is in full swing, and we are seeing some tight capacity there. Areas like California, though, is seeing extreme decreases, mostly due to imports going down. And then other areas of tightness would be the border. So you'll see tightness around Yuma, Nogales, McAllen, Laredo. Most other places in the country right now are pretty loose and capacity is fairly available. So where are rates going? So we expect dry van rates to continue to decrease until pretty much right before Thanksgiving. We expect that they will decrease at a slow rate. We don't expect to see the huge drop that we saw over the last month. If you look at the graph, over the last couple of weeks, we saw a very significant drop in dry van rates. The reason that is because there's a reverse correlation with line haul rates than there is with fuel. If you have a very steep increase in fuel, typically you have a steep decrease in line haul rates, and vice versa. If fuel were to drop, it tends to then push up line haul rates. So because there was a very steep increase in the cost of fuel, we saw a very steep decrease in the cost of line haul spot rates. We do expect rates to continue to go down for the rest of the year and actually into Q1. Again, the only exception being during the holidays. So Thanksgiving, Christmas, New Year's, we do expect to see normal holiday increases during those points. But overall, we should see the trend line continue in a downward fashion. Reefers. Okay, so reefers it's a similar picture to what happened with dry van rates. The reefers are actually down 36% year over year, year to date. We actually saw a larger decrease over the last couple of weeks, last 2 weeks than we saw on the van side. Again, the main reason is fuel. So reefers actually use more fuel than vans. They have to run the reefer unit with diesel. And so the correlation is just a little bit stronger, the tie between diesel prices and spot rates. Again, these are line haul specific. So it's not that necessarily the rates are getting cheaper overall. It's that the line haul is getting cheaper because the fuel is more expensive. Again, the notable exception is in the PNW. We've seen almost just under $1 increase per mile over the last 3 months in the PNW. This is historically normal. Produce season is very swing heavy in the PNW, where capacity is a little bit tighter because there's just less trucks in the Northwest. So that will continue through the end of the year. Typically, it'll drop off after New Year's. Where do we expect reefer rates to go? So you can see the significance of the last 2 weeks and how fast reefer rates dropped. We do expect that to kind of slow down. The reefer rates as a whole should still continue a downward trend until Thanksgiving, and then through the end of the year until Christmas again. Historically, reefer rates will not bounce back until spring. So we expect a slow downward trend with only a few select areas, and then a few select times, like during the holidays, where rates will bump back up a little bit. The flatbed market. So the flatbed market is actually kind of interesting right now. We are seeing record posts for available flatbeds. The load to truck ratio on flatbeds is actually almost at a historic low. A historic high. There's actually almost more loads per truck right now than we've seen in years. And so it's causing rates to drop very quickly and very steeply. It was a little bit interesting because typically with hurricanes, we see a very sharp spike in flatbed rates. We see capacity tighten very, very quickly. And this hurricane was a Category 5. It was a significant hurricane. But as you can see in the graph, it was only about a week spike. Before then, it decreased for almost 2 weeks straight. This is not normal. It's showing how loose the capacity is in the flatbed market. it's showing how much available capacity is out there, to where even with the influx of emergency freight for the hurricane, there's still a lot of available capacity in the flatbed sector. Notable exceptions, Texas is still a little bit tight, but there's still available capacity there even. And the only reason Texas is a little bit tight is we have seen, due to oil prices starting to increase again, fracking has expanded and continued. And so there's now, I believe it's pretty close to the record number of oil rigs going up in Texas. And so that pulls some capacity from the flatbed market. But even there, again, it's still fairly loose and fairly available. Rates are down 50% or 50 cents a mile year over year, and 20 cents a mile just compared to last month. So it is significant. And if you have a flatbed freight, I recommend trying to negotiate down your prices. So flatbed sector is the only part where the forecast is a little divergent. For van and reefer, it was very much in agreement, but flatbed's a little bit divergent. The main reason is historically we do see a push during this time due to hurricanes, due to last minute construction going on, and then that's just not happening this year. We had the hurricane, but it's just there's so much capacity out there and so little freight that we do expect rates to continue to go down. So that yellow line that you see is most likely what's going to happen. The notable exception is when we hit the holidays, you will see a spike again, and that should continue through the winter. If anybody does have any questions or concerns or any specific topics you want me to go over, I'd be happy to do that. This month, the notable thing to keep an eye on would be what happens next month with the railroads. Again, it's unfortunate that we have to keep watching this, but if the unions do go on strike for any reason, estimated impact is almost $2 billion a day. So it is significant. A good portion of our freight does move on the rail lines. So if the unions do go on strike, that will impact California. It will impact most of the major cities in the US. And so it's something that we just need to keep an eye on through next month. I will make sure if anything major happens, we will send out notifications to everybody. And again, if you have any questions, concerns, don't hesitate to reach out to me, or reach out if there's a specific topic you want me to go over next month. But thank you very much.